In today's housing market update, I'll be covering interest rates and where they are likely heading, the latest foreclosure data, new home builder starts, and the most recent and shocking changes to the housing market that's affecting both buyers and sellers. So let's get started. For those of you that don't know me, I'm Rick Harrison with MVP Realty here in Southwest Florida. And on this channel, I bring you the latest insights and information to help you decide if this is the right time and place to make your move to paradise. If that thought's crossed your mind, you're in the right place. So subscribe and tap the bell to stay up to date on the latest information, keeping you ahead of the curve. All right, now let's dive into today's economic stories. All right, so the first story that we're talking about today comes from Bloomberg, and this obviously has to do with the macroeconomics, what's going on in the market right now. Fed officials, obviously after the last FOMC meeting, decided that with everything that's coming out with the job reports and the economy supposedly staying stronger than expected, inflation, CPI has come down to the 4% range, but we're still 2% away from their inflation target range, which is 2%. Policymakers will need to raise interest rates further this year to bring inflation back to central bank's goal, down a little bit further, likely to need a couple more rate hikes over the course of this year to really bring inflation back into the path that's along a sustainable 2% path. The next FOMC meeting is on July 25th to 26th, and it's expected to resume rate increases at the meeting, probably looking at a quarter point at least per meeting. But there has been talk of up to half of a percent. This next article comes from Bigger Pockets, one of the larger real estate investor portals or forums, if you'd want to call it that. This key banking figure just gave a dire warning. If inflation isn't tamed and consumer prices remain high for much longer, banks could see credit losses of similar order of magnitude to those of the 2008 financial crisis. We've talked a little bit about some of the things that are going on in the commercial real estate market is having an effect on this. So why the cause for alarm? Really, it comes down to if a banking crisis does come to fruition, there could be sweeping impacts on the real estate world. For one, lending would tighten considerably, which we obviously know, making it difficult to finance deals and developments. So that's where it kind of plays into the commercial real estate market, but also just the residential market as well. Demand would then fall for housing, which could push prices down, and we already know this. So would they crash though? It would require a number of dominoes to fall. So this is where it becomes a little less likely. There would first need to be widespread job losses, which would make it harder for most people to make mortgage payments. So that would have to be a pretty broad and widespread job loss throughout the market. It also would have to eventually lead to a wave of foreclosures and a glut of housing supply that could tank prices. That's a lot of what ifs. And according to the BIS, there's still a chance any huge losses can be avoided, which as of right now, we don't really see any signs of this. And we're going to go into that right now. Here is the latest foreclosure data for Q1 for 2023. And as you can see, I mean, we were almost at 1 million properties or filings in the 2008-2009 Great Recession. We're way down here. We're almost at 100,000 filings. Although it has gone up quite a bit, and the stats were it was doubling this month or tripling, but it was at such a low rate for such a long time that doubling and tripling the amount of inventory is only bringing it up to 100,000 filings or so. So we're way away from enough foreclosures to make any significant changes in the market right now. That doesn't mean it can't come, but as of right now, I'm trying to give you the most realistic data in real time. There's nothing that's suggesting that foreclosures are going to make enough dent in the inventory shortage to actually bring prices down a lot. On top of that, this is from Nick Gurley. If you guys watch Reventure Consulting on YouTube, he has a lot of data that he puts out, does collect data from places like Zillow and Realtor.com. So this is all going based on those private companies' information as well, which both of those companies are in the market for selling homes. So I would not count on it completely, but it is a data point to take a look at. With this, his builders report, he just a surprise surge in home sales for new homes and builders. It's up to 15.1%. So a lot of people are moving to the new homes market. That goes really hand in hand with the fact that they have a lot of incentives. They're paying for closing costs in most builders and most communities. They also do have buy down programs. Some of them are 30-year fixed mortgage rates at 5.5% or so. Some of them are 1 and 2 year buy downs, which means that the interest rate does get adjusted in year 3 up to whatever the current market is at. But his analysis suggests that builder sales are increasing. The housing market as a whole is struggling. because resale activity is still languishing near 2008 crash levels. His takeaway from this, the median sale price of new homes falling by negative 16% in October, suggests that it's much larger than what occurred in 2008 crash, when builders were much slower to cut the price. Now, there's a couple things that you can factor into this, though. One, the fact that builders for the last several years have been building luxury properties, and now there's really a need for really entry-level homes and first-time home buyer homes. That's where the big demand is right now. So if I was a builder and I was looking at the market where the most demand is going to be right now, I would be starting to build smaller homes or starter homes, which is going to bring down the median price and average price of a home. A lot of these homes that were being built over the last several years are in developments that have been under construction for multiple years. So I think that is starting to shift, which is going to bring the prices down a little bit. But there were some home cuts, but not as much as you'd expect, and not as much as this chart or these graphs lead on. And then finally, Redfin had put out their own housing market update. The average U.S. home is selling above its asking price for the first time in nearly a year. Just some highlights: average 30-year fixed mortgage rate was 7.8%. Surprisingly, people are still buying. Mortgage applications during the week ending in June 23rd rose 3%. That was still down 21% from a year earlier. But again, there's not a lot of inventory out there. So people who might be searching on the sidelines haven't applied for mortgages yet because they're not seeing anything that they are really interested in yet. Google searches for home for sale were up 5% from a month earlier, and touring activity was also up 6%. So things are still competitive. Also, sales prices increased most in Milwaukee, Providence, Newark, New Jersey, Miami, and West Palm Beach, two of those in Florida. Those are both up 5% and 6%. Months of supply was 2.6 months, so that's near the lowest level in 2 years. Again, we're at all-time lows for inventory here. 36.8% of homes sold above their final list price. That's still telling you that the market is competitive. That's the highest share in 10 months, but it's also down 51% from a year earlier. That just tells you how crazy our market was. And then the average sale to list price ratio, which measures how close homes are selling to their final asking prices, was 100.1%. So that means that on average, homes are selling actually at or a little bit above asking price. So that just gives you an idea of what the market conditions are like. All right, before we get into the local housing market stats, I did just want to address this because it was the thumbnail for this video. Interest rates. So if you follow me or most of the real estate agents who know how mortgage interest rates are really viewed, the 10-year bond market is what is usually the best indicator for where mortgage rates are headed. As the bond market moves, usually interest rates move as well, because that is the lending. That is what banks lend money to each other by, and that is what most of the mortgages are based on. So this chart shows you, this is over a 3-year period. You can see these little Fs that are drawn in that are called what's called bull flags. So basically the channel goes down for a certain amount of time, and that usually indicates that there's going to be a breakout to the higher side. That breakout is usually the same length as the flagpole. So this is what's called a bull flag, and because it looks like a flag. So the flag poles are indicating right here the length of the increase that will happen outside of on top of the flagpole. So you would just take this line here and you just bring it right up, and that is where most likely rates are heading next. Now, is it always exact? No. And it usually isn't a straight line to it. There's usually jogs, as you can see. If you get rid of these lines, you can see it isn't a straight up arrow. It comes down a little bit, then it goes back up, then it comes down a little bit, then it goes back up. So right now we're hitting support on the top of this flagpole, and I'm guessing it's probably going to bounce higher. So if this chart does play out and these flagpoles do play out the way that they look like they might, we are looking at interest rates going to potentially 8%. And higher, depending on how that 8% plays out as well. On top of it, this is not necessarily a widespread view, but this is my personal philosophy on the markets. Everything is a cycle, and there's a 100-year cycle. There's also a 40 or 50-year cycle as well. As you can see, all the way back to 1955, interest rates continually increased. They went up and up, and then they came down, they went back up, just kind of like that flagpole I was talking about. until they got to the 1970s and 80s, where we hit all-time highs for inflation and something had to be done. Volcker stepped in. He raised the interest rates to a point where it was unbearable. Then they were able to lower the interest rates. Same time, we also went off of the gold standard completely and into fiat currency. When that happened, the Federal Reserve was then able to actually continue lowering rates in order to sustain the economy the way it was. So ever since the 1980s, we've been lowering rates to the point where over the last 2008 financial crisis, we got to 0% interest rates, which is the lowest they've ever been. And really, that's about as low as they can go. You can go into negative, but that's when banks start paying you to put your money in their banks. But we've gotten to the point, like I said, we're basically at 0%. So there's really only one place to go, and that's up. If this cycle starts over as it has, that would mean that we're heading into a continually increasing, at least decade, if not multi-decade cycle, where we have to bring back interest rates back up to sustain the economy the way it's been heading and keep growing. That's not necessarily guaranteed, but that is my view on it. I think we are heading into a cycle where interest rates will continue increasing, and 6% is probably going to become the new norm again for mortgage interest rates. Anything below 6% really is artificially low. Now let's head over to where interest rates are right now. So this is actually as of 7/7 last Thursday. Interest rates went from 6.6 or 6.7% the last time we did this market update to over 7% now. Same thing with bank rate, has us in the same spot. Cape Coral to Naples, the latest trends and changes in the data. New listings went from 805 to 680. That's down 16% week over week. Solds, 692. That's actually down a little bit, 2% to 684. And then pendings went from 825 to 659. So pending is really what's going on in the market right now. And that is usually an indicator as to what's on the market. And for new listings to be down so much, it only makes sense for pendings to be down because there's not as much inventory to choose from. Price decreases, 814 to 778. That's down 5%. And then actual inventory breakdown, single family homes, we gained 88 units over the last week. Condos, we actually lost 21 units. So the previous market update, we had a gain of 216 units on the market. This week, we still have a net gain of 67, but it's not really increasing as much. Multifamilies, really not much of a change here. We gained 3, but 116 is pretty good amount of multifamilies on the market. And then foreclosures, we had a gain of 2, but it's still hovering around 30 foreclosures on the market right now. Total sales, we had 517 total residential sales over the last 7 days. And out of that, 261 of them, or 50%, were cash sales. And that is actually down. The ratio of cash sales is down. Punta Gorda to Sarasota, new listings went from 617 to 610, just a 2% loss there, not much. Solds went from 641 to 696. That's up 8%. So there are still quite a few buyers in the market, more buyers than sellers. Pending 663 to 571. That's down 9%. And that goes hand in hand with the number of solds being increased and the number of listings being decreased. Price decreases 852 to 738. That's down 14%. Inventory breakdown for this area, single families, we gained 232 units on the market week over week. And then for condos, we gained 33. So we had a net gain of 102 last market update. We have a net gain of 265 units this week. Multifamilies, again, not much of a change, up 5, but still right around where it's been. And then foreclosures, we actually lost 8. So there's more foreclosures in this area of the market than there are in the southern part, but still those averages are coming out. There's really not much of an increase in the amount of foreclosures. Total sales, 559. Out of that, 247, and 44% of those were cash sales. So that is the biggest update there. So key takeaways for this week's market update. For buying, really home values have stagnated. Resale inventory is decreasing right now. New home inventory is rising. Builder starts and actual new builds coming to market. New sales are increasing still. Foreclosures aren't really helping yet, at least. And we'll see how that plays out with the job market. And then buying is still competitive. So there are still a lot of buyers in the market versus what's available for sale. For selling, if you are planning to sell, buyers do have some leverage in today's market. Things are sitting longer. Sellers are getting nervous about things sitting longer, and they're not selling as fast as they expected. So buyers are actually getting some concessions from sellers. So just expect that if you are selling. Homes are taking longer to sell, on average 30 to 45 days in some markets. They are selling below asking price in some markets as well, as low as 95, 96%. But still pretty close to what asking prices are. If you do sell high, you got to realize when you sell high, unless you're going to be renting out for a year or possibly multiple years, you are probably going to buy high too. Cash buyers are obviously in the best position because they don't have to worry about interest rates right now being so high. But home buyers, if you are selling, just realize you are going to be paying probably more. If you have a 3% interest rate, you're probably going to be paying more if you buy right now, or sell and buy right now. Prices are still near all-time highs for you sellers, so that is a pretty good situation for you. However, where you're going to be moving to, that's going to be more of the bigger concern here. Bottom line, really, buying and selling needs to make sense for you. It always does. Don't listen to anybody who tells you you shouldn't buy right now, or it's not a good time to buy right now, or you should buy right now, or it's a great time to buy right now. Or vice versa in selling too. Do what's right for you. You have to lay out and look at all the options, see what really you can do, what things are going to cost, and if it makes sense for you. So if you have questions on that, or you want to run some scenarios by me, feel free to reach out to me directly. I'm happy to give you some advice or my input on, what options you may have in this current market conditions. As always, we've got a lot to keep an eye on, and that's exactly what I do on this channel every week. So don't forget to subscribe. And if you're planning to make a move to Southwest Florida in the next 6 to 12 months, I've created some unique programs and services to help make finding that perfect home simple and stress-free. Just check out the links in the description. And as always, if you have any questions, feel free to call, text, or email me anytime with my contact link in the description. Thanks again for watching. I hope to see you on the next video. But until then, stay safe, stay positive, and more importantly, stay free.